Welcome to the Explainer. If you've been around the crypto block for any amount of time, you already know the drill. There is absolutely no shortage of noise, hype, and wild speculation out there. Well, today we're cutting right through all of that. We're going to look at a genuinely fascinating white paper put together by the Elite Solutions Sweden research team called Retail Crypto Trading Under the Microscope. Instead of chasing the latest Reddit rumors, we're going to roll up our sleeves and dig into the actual business models, the real risks, and the unvarnished realities of crypto trading. Okay, let's dive into this. Evidence, not narrative, is still the better guide. That quote right there, that is the beating heart of this entire white paper. For years, retail investors have been sold some pretty incredible stories, right? Tales of decentralized utopias and magically guaranteed yields. But this research team makes a rock-solid argument. If we actually want to protect our capital in this space, we have to aggressively prioritize hard, verifiable data over the industry marketing hype. So here's our roadmap for today's deep dive. First, we'll look at the evidence over narrative. Second, a season of collapse. Third, anatomy of the contagion. Fourth, old failures, new costumes. Fifth, inside the 10 chapters. And finally, we'll wrap up with the path forward. All right, let's kick things off with part 1, the evidence over narrative. The research team basically built a massive 51-page survival guide, and what makes this so incredibly valuable is that every single claim, from the original Bitcoin white paper all the way to the 2024 ETF approvals, is independently sourced. They didn't just take people's word for it. They dug into complex regulatory filings, on-chain data, and messy court records to show us exactly who actually profits in crypto, and more importantly, who gets left holding the bag. Moving right along to Section 2, a season of collapse. Let's move to and see how this builds. Look back at 2022. It's actually pretty chilling when you see it laid out like this. Over just 6 brutal months, 4 of the most consequential failures in crypto history took place. It kicked off with Terra and Luna in May, which slammed right into 3 Arrows Capital in June, brought down the Celsius network by July, and then, of course, culminated in the spectacular, absolute implosion of FTX in November. Now, the report makes a super critical distinction here. These 4 monumental collapses, they were not independent accidents, not at all. They were a tightly linked chain reaction. Each failure weakened the overall system just enough to make the next one highly probable. It was a massive contagion effect, moving with a speed that we rarely ever see in any major asset class. Which brings us perfectly into part 3, anatomy of the contagion. So it all started with Terra USD, or UST. Normally, a stablecoin is supposed to be pretty boring, right? It's supposed to be backed one-to-one by actual dollars sitting in a real bank. But UST was an algorithmic stablecoin. Instead of cold hard cash, it tried to maintain its $1 peg through a complex algorithm tied to its sister token Luna. Basically, it was backed by math and hope. Yikes. This highly experimental setup completely set the stage for the first domino to fall. So you might be wondering, why on earth did so many people trust it? Well, 20%. That was the magic number. A lending platform called Anchor Protocol promised depositors nearly a 20% annual yield on their UST. Compared to a standard savings account, that is an astronomical figure. It drew enormous amounts of capital into the system. But the second confidence waned and that peg slipped, the algorithm went into rapid reverse, literally erasing tens of billions of dollars in under a week. Now, what's really interesting about this chain of events is how that single Terra collapse completely shattered the wider ecosystem. It immediately triggered margin calls for 3 Arrows Capital, which was a heavily leveraged hedge fund. When they defaulted, it crippled their lenders, forcing the Celsius network to completely halt customer withdrawals. And by November, the contagion had infected the absolute center of the industry, taking down the second largest exchange globally, FTX. And speaking of FTX, the fatal blow there wasn't just standard market volatility. It was commingled funds. Customer deposits were being mixed with company assets and secretly funneled right over to FTX's sister firm, Alameda Research. Let's be clear, this wasn't some complex blockchain glitch. It was straight-up fraud, which ultimately led to a 25-year prison sentence for its founder, Sam Bankman-Fried. Shifting gears now to Section 4, old failures, new costumes. And this brilliantly illustrates just how dangerous a convincing narrative can be. Take the Celsius network. Their public story, their marketing pitch, was that they were a perfectly safe alternative to a bank, offering 17% yields. But the hard evidence, which was later uncovered by a court-appointed bankruptcy examiner, revealed they were actually operating at a deepening deficit. They were using new depositor funds to pay the old ones. The examiner explicitly compared the whole operation to a Ponzi scheme. So the crucial point is, when you strip away all the fancy blockchain terminology and the tech hype, the underlying failures here are identical. We see capital borrowed against the exact same collateral multiple times, and customer deposits being secretly used without any permission whatsoever. The authors point out a fascinating reality. These aren't uniquely crypto problems. They are centuries-old traditional banking failures, just wearing a shiny new technological costume. As the report profoundly summarizes, a single season of failures did more to define retail trust in crypto than a decade of steady growth before it. This catastrophic 6-month period completely forced a massive regulatory retreat. It left the surviving exchanges desperately scrambling to publish proof of reserve disclosures just to try and win back our trust. Let's zoom out a bit for Section 5, inside the 10 chapters. That devastating 2022 contagion we just walked through, that is actually just one single piece, Chapter 7 to be exact, of this massive 10-chapter masterclass. The full white paper is designed specifically to protect retail investors by stripping away the clever marketing and showing us the bare, mechanical reality of the entire market. The first half of the book is an amazing deep dive into how this industry actually evolved. It covers the historical rise from early Bitcoin all the way to the 2024 spot ETFs. It explores exactly how these exchanges generate their revenue, and heavily notes that their incentives rarely actually align with ours. It even gets into the strictly documented success rates of leveraged retail traders and the intense, very real behavioral psychology behind FOMO. Then, the final chapters pivot purely to defense. They meticulously map out trading rules and the early warning signs of platform distress. They do a fantastic job comparing the very real risks of spot trading versus DeFi and derivatives. Plus, they document how global regulations are currently scrambling to close the exact loopholes that were so disastrously exposed back in 2022. Which leads us right to our final section, Part 6, The Path Forward. Listen, the era of blindly trusting an exchange founder's late-night tweet, that is officially over. The Elite Solutions Sweden research team has put 10 chapters and 51 pages of heavily researched, unvarnished industry analysis right on the table for us. Understanding these precise mechanics and the actual realities of these business models is absolutely the only reliable way to navigate this market and protect your hard-earned capital. We're going to leave you with this one provocative question. The next crypto cycle? It's already building. The marketing machines are spinning back up, and brand new promises are being made. So, as you prepare to allocate your capital, ask yourself, will you rely on the narrative or will you demand the evidence? Thank you so much for joining us for this explainer, and remember, out there in the crypto wild, evidence is always your best guide.